Okay, so the first chapter in our third unit is chapter 7, which deals with um, receivables. So we'll start with the heavy lifting in this chapter is valuation of accounts receivable. Um, and we'll also talk about notes receivable, which bear interest. So that's what we'll do in this chapter. And you may have wondered what happens with a receivable, because there's no guarantee you're going to get paid anytime you're owed money. You hope to get paid, but you may not actually collect on those receivables. Um, so that's where we're starting. So as long as you are owed, there is risk that customers will not pay. All right. And so there are two methods of accounting for bad debts. The first is the direct write-off method, which is only appropriate when receivables are relatively small and immaterial relative to the overall financial statements, i.e., primarily in cash businesses that don't have a lot of receivables. If receivables are material and you do a lot of business on credit, you need to use the allowance method. GAAP mandates that if receivables are material to the financial statements, you have to use an allowance method. And there are several versions that we'll discuss in this chapter. All right. So the idea is that when you make a credit sale, there's a risk of non-collection and there's an expense. So if you make enough credit sales, you're never going to collect all of the amounts owed. So there's an expense associated with bad debts. The risk that some people that owe your business will not pay. All right. So we match that principle, we match that expense to the period in which it's made. All right. And that's accomplished with the allowance method. The direct write-off method does not match bad debt expenses to the period in which they occur. All right, and the materiality of really just deals with how big receivables are relative to the rest of the financial statements. All right, so GAAP mandates what we refer to as an allowance method. This means that the accounting department or the accountant guesses or estimates, it's an educated guess, how much or what percentage of receivables will not be collected. All right. And you record that estimate. So you take an educated guess, usually based on past performance or industry trends, and you record that. So the advantages of using the allowance method, well, it records the expense in the period in which the sales were made, which provides for more accurate income numbers. And it also allows for receivables to be fairly or more accurately stated on the balance sheet. Right, the receivables number will show the estimated collectible accounts. Right, because if you know that some amounts in receivables will not be collected, it's misleading to show that full amount. All right. For estimating bad debts, we're going to talk primarily about two methods, and really it's more of a branching. The percentage of sales method, which is quick and dirty, we'll talk through that. And then the accounts receivable based methods. And there are actually two of those. Percent of accounts receivable, which is also relatively quick and dirty. And then the aging of accounts receivable, which really is the industry standard. That's where we'll spend most of our time.